Hey traders, Raghee here. Happy Friday, everybody. Welcome to Charts and Coffee for June 18. Great to see everybody. Hope everyone's doing well. And we've got a lot to process this week from the Federal Reserve basically saying there's no inflation, and the stock market and the commodities market and the treasuries market sort of buying into that. Very interesting where where we sit as we wrap up this week. Now, as if the Federal Reserve's roller coaster wasn't enough, we've got triple witching, quad witching, however you want to look at it. So we have another major expiration, another major caution day, another potentially volatile session sitting in front of us. And so for me, having to had, and again, I mentioned this in the rooms, and I mentioned this to the members in the futures room and in the sector secrets room and the options room, that it's really important to, on this side of the mic, just say, hey, look, there are pullbacks that don't turn into retracements and they break the previous trend. Gold is a great example. Silver is a great example. I do believe that gold and silver going into the Federal Reserve event was a solid trade. But what's really funny is it doesn't matter what I think. Macroeconomically, has anything changed? No, the Federal Reserve basically said there's no inflation. The market said, okay. And so kind of like an SNL skit, here we are. But I've got to accept that there's a threshold of risk that I place on my trades to prevent any single trade or group of trades from blowing up my account. If I'm down 15, 20, 25% of my account, if that were to happen, those ebbs and flows happen. But remember, risk of ruin waits at about 50%. You've got to avoid that magical, nightmarish number in terms of concentrated bets on a particular symbol or concentrated bets in a group. So we've just got to accept what I like to call the paper cuts and move on. So this week, did I take some paper cuts? Heck yeah, I had to take some paper cuts this week. The reflation trade that had been working for me for months has finally unwound. I have to accept it. Thank the market for the wins that trend, macroeconomic trend and technical trend gave me, and say, well, right now that the wheels have fallen off that wagon, right? And let it go. Now, let me warn you of the second thing. The first impulse is to go after the market that just took your lunch money. Now, there are plenty of markets that didn't take my lunch money. My long bond position, my long healthcare, right? There's corners of my book, my trading book, my open positions that are in unrealized gains, in realized gains, and continue to work. If I am so consumed with sort of revenge trading that I want to go back into gold and back into certain currencies to get my money back, I'm looking in the exact wrong place. So right now, this Friday, if you want to take stock of what's working in your book, and there should be a lot that's working in your book, right? If you've been looking at trends, whether they be macro or technical trends, and that's what should get your attention. So for me, I let go some of the junk in my book now because those trends have been broken. I might be back, I may not be, but there's corners of the book that are working. So that's my advice here on this Friday. Take stock, quite literally, of what you have and determine whether the trends are still intact. And there are a number of places where the trends are still intact. And those are places like, for me, I've loved the trend on the S&P. The trend on the Dow broke, by the way. I love the trend in financials, but that one broke. There are corners of some of these trends in the broader sense where the trends are still intact. So I've got a broader financials trend, and then I could also see that while that's kind of come upon some red grab candles and a pretty significant amount of bearishness, I also know that Schwab, which is a little bit lower weighted within the XLF, is still intact. And this is sort of the sector secret, if you will. This is the not so secret of understanding relative outperformance and lower weighted stocks that may not go out with the larger tide with quite the speed that the heavier weighted stocks, think JP Morgan, would, right? JP Morgan, far heavier weighted within the XLF, Schwab, far less. And you can see the way in which the XLF has a little bit less influence over the lower weighted name. If you can understand just the conversation that we've had here in the last 5 minutes, it is going to make a sea change in the way in which you trend follow and swing trade. So that's a lot of what I'll be doing here today. Again, I think what's sort of the oddity of this week is the mixed bag of dollar strength, gold weakness, what inflation all of a sudden doesn't exist because the Fed said so. I was thinking about this last night, and then all I could think of, and I'm not a huge wrestling fan, but John Cena, I remember one of my friend's kids loved John Cena back then. You know how he does that whole "you can't see me"? I feel like that's what the market just had. Inflation's like, you can't see me. I'm like, oh my gosh, this is the market environment that we're in. So let this week complete. Don't make any big bets. I do think the buyers will be back. We just need to get through the volatility of the FOMC to triple witching sandwich of what's been kind of chaos. And I say chaos, not because the markets are pulling back. I say chaos because the message that the different places in the market are communicating is very mixed. There's a lot of traders that really don't know, including myself, and investors that really don't know what the next move really should be. Because remember, disappointing data between now and 2023, right? This is what we're dreading. Disappointing data between now and then about growth and jobs and say cooler inflation could very quickly change the way in which the Federal Reserve is going to handle, this kind of ever evolving economic picture. And so at the end of the day, the only picture that does matter is the one that the Fed paints. And right now, I think that painting has caused a lot of confusion. It's a little too abstract a painting. All right, so that is where we are right now, and it's okay, right? I mean, it's okay. We're going to readjust, and we'll find which trends are going to reemerge, and they always do. It may not be the same place that you or I have been trading the last 2, 3, 4 months. For me, almost the entire year, but we will find those other trends that are emerging because money flows like water, right? It's just going to find another path of resistance. So we'll find what that is. And that's what we'll spend the remainder of June doing. So I'm really optimistic. Those of you that might be looking for a good read, I'm always reminded, those of you that are Ryan Holiday fans, I'm a big fan of, thumbing through my daily Stoic every morning. And I just keep remembering the title of a very, very good book. It's an older book now, but definitely worth the read. The obstacle is the way, right? The obstacle is the way. All right. So with that being said, let's jump into our questions. Thanks as always for being a part of Charts and Coffee. And let's get to it. All right. So first question. Hey there, James. Thoughts on XLE? Lots of thoughts on XLE. XLE, right? For sure gives me the feels. I think for sure I like this one a lot because if there's a commodity that sort of, did one of these to the Federal Reserve's messaging, it is crude oil. So I like crude. If I like crude and I like RBOB, of course, as a commodities trader, I can absolutely get into that narrative. But the knock-on effect, right, is going to be not just XLE, which is predominantly Chevron and Exxon, but it's also then going to likely extend to OIH, Halliburton, and Schlumberger, and into the oil explorers, which is not a high concentration weighted ETF, but you can see the JT multi on both these charts. So again, what I'm talking about is this lower area here. That's the XOP. Here is the OIH. Again, take a look at that lower JT multi and the quality of the trend. And then finally the XLE, which, to your point, my friend, we've got a double green. We've got a pullback into the wave. We've got the beginning of what could be the Darvas pattern forming. We've seen pullbacks into the wave before. set up buys for that. And yeah, I will set up a buy for this. Yep, I will set up a buy for this. And if you remember the notes, those of you that have my notes from yesterday, there were a couple corners of the market that we were looking at. This is definitely going to be one of them. So I know that on a week where many of the reflation trades have caused those paper cuts, we've had to take some, take some positions and take them out of our book because the structure isn't there and the tolerance for risk has been broken. What we do now, the next trade, it's always going to feel a little uncomfortable. But right now, there's a corner of the SLX that I like. There's a corner of financials that I like. I showed you that already. And this would be a really nice play, a corner within the reflation environment that I do like. So absolutely, absolutely. Now, should we wait till after triple witching? So this is where, James, think about the zones, right? So today, let's say we enter around 54.10, right? Let's say we enter in that area. We would still be open to entering here and here. So remember, this being the aggro level, it would be the smallest anyways. And as long as I can tolerate the risk, right, of our percentage threshold, I don't have a problem with it. It's aggro, so I'm going to be taking a small position anyways. And, everything other than the potential volatility of today's session, we already know what the Federal Reserve's impact on this market was. There was a little bit of news in crude, which is a mixed bag. We are looking at some potential supply issues. I think the overall trajectory of crude is still bullish. And so USO is on the radar, James, and XLE are too. So if you can handle the volatility, you sort of put that tolerance into your mind and into your trading plan, I really don't have a problem with it. I really don't. So thanks for the question. Would I buy physical gold and silver? Well, again, the reasoning for that would be what, right? Everyone's going to have a different reason. Gold is considered the inflation hedge, and the Fed said on Wednesday, well, there is no inflation, or we're going to tackle it. It's kind of ludicrous that gold is down where it is here in light of what real yields have been communicating, which is the nominal yield of a bond minus the rate of inflation. I think it's bonkers that gold is down here where it is. I will be looking for another opportunity to get long. It'll be an oversold buy. But as far as physical gold and silver, Glenn, I can't tell you, it's not a trade, right? To buy physical gold and silver would not be a trade. But I've had physical gold and silver, for decades. I really haven't been adding to that physical gold and silver position. But again, that's a little bit different than the conversation in terms of a trade. And look, I think it is smart to have physical gold and silver. But let me backtrack. I'm Indian, my mother. So gold is sort of a thing that we have. It's just, I've got a cost basis in gold that's low enough where I don't feel the need to add at 1175, for example. But I think everyone should have a physical gold and silver. And so pullbacks like this truly would be opportunities in that regard. But for that type of approach, I would recommend a weekly time frame, all right, for that type of approach. So yes, I am a fan of buying it. It's something that I've been doing throughout my career. I've been buying physical gold since, well, again, I can't take credit. This is my mother. I've been buying physical gold since high school. And I went to high school between 86 and 89. So you can get an idea of, yes, I'm a big believer in that, but it's got to be, on pullbacks for me. And it's really been mostly a weekly or even a monthly chart that I will do that based on. Okay. So big fan of that. I do like that. Look, some people take profits from their trading account as I do, and they'll buy longer term holding in stocks. I've done that. Some people take the gains from their trading account and buy maybe treasuries, or they'll buy real estate, right? Or I think gold is a really good alternative. So you take the gains from your trading and you put them into something like that. I've got no problem with that at all. In fact, I do it. So I just don't know that this would be a level that personally I would do it, but a pullback is always a better time. It's on sale, right? Okay, so next up is XLF. Hey there, Eric. I like XLF. I think XLF has been unduly hit because of the outgoing tide in the narrative this week. So I'm looking at relative outperforming corners of the XLF. But if you have a tolerance to take a little bit of heat, I agree. This is where I'm saying that different corners of the market, the corner of the market that says the Fed just can't make inflation go away with the old "because I said so," right? But yet there's a corner of the market that's responding that way. Another corner of the market is saying inflation is here, but the Federal Reserve is going to start to go hawkish. We've seen the dollar strength and we've seen the gold weakness. There's that school of thought. But then there's this school of thought where we forget, and this is something that a lot of traders don't know. The Federal Reserve actually increased their asset purchases, because you can track that with the Fred data. So it's kind of perplexing that the very punch bowl that's been spiked now for years continues to be spiked. But because of something that could happen in 2023, the market basically flushed. And I think there's a disconnect that we're going to, as the dust settles, right? There's a disconnect. And so I think it's better to be patient and just find out where the heck is this market wanting to rotate to other than tech. I mean, tech has been clearly a beneficiary of the reflation trade. Think transports, industrials, the Dow, commodities. I think that basic materials, I think that if there's any place that we've seen a renewed interest and flow, it's been into tech. It's been into a market that frankly isn't in an uptrend, but is sure enough starting to give the early signs that it is trying to turn into an uptrend. And this is the daily chart of the NQ. So thanks for the question. Yes, I mean, look, I think it's really important to say this week's response to the Federal Reserve was a mixed one at best. It wasn't an organized one. There's too many moves that seem in conflict with one another. If we want to go defensive because the Federal Reserve is supposedly changing their policy and changing their tone, utilities were down, staples were down big. So it's a curious reaction. And there's so many places where the conflict in harmony, the conflict in what would typically be sort of a defensive posture looks very, very strange. All right. So next up is the XLV and the ACA. So I have faded the previous moves to the downside on that. And this one was no different. The move to the downside, and it was a little bit more violent than the previous dips as the High Court was making a decision on ACA. Again, my bet was to the long side for two reasons. Fading the ACA the last two times with buying a dip and then expecting to move higher has worked. And then remember that the overall trend in healthcare has been up. So again, I can't pick a top here. When I look at, even when we do go into sideways action, the overall trend is segueing out of a double green. So that does lead me to look at long positions, even when things get a little bit more volatile. All right. So thank you for the question. Yeah, we're long. That's, when I talked earlier about what corners of your book are working really well, in the sector secrets, our reflation trades either got break even, stopped out, or stopped out at a loss. But then there's corners of our book that are working really, really well. Certainly healthcare. And then I think we've already hit targets in Pfizer. So it's a mixed bag. Some parts of the book are working well. Some parts of the book got hit. And the reflation side of the book definitely got clobbered. And again, I think it's really important that when we have losses is be upfront about them. Because the more that we want to sweep losses under the rug, the less likely we are to just take the loss and move on, right? Took the loss, moved on. And I will free up that mental capital and quite literally my capital, my account, and redeploy it. But for me, likely there's 2 or 3 places that I'll look at maybe buying today if we get some triple witching weakness. If not, next week, I'll be ready to get back to work And I'm looking forward to that. Next question. Hey there, Pamela. Watched your webinar last night. Well, thank you. Cool. Are the HPMRs calculated? One of the indicators that we get. Oh, okay. So yes, what are the indicators that you get with the class? My VWAP Max toolkit, which is 4 indicators: V-score, V-score bands, the volume profile tool, the V profile, as well as the anchored volume weighted average prices, both for intraday and end of day. It's a heck of a bundle. Yeah, it's a heck of, so you get that, as well as the upgraded V-score with the signals. Okay, you get that. I'm throwing in the volume flags, which you can see at the very bottom of my screen. Lorna took those and tweaked them. And what this allows me to do is see at a glance whether or not, based on a certain customized look back, I can look back a week, a month, whatever, and say, is this beyond the average, which I love. I can really look at volume in terms of abnormal volume at a glance. So that's going to be included as well. And then we have, oh, right. And so HPMRs have to be updated. So you will get the current volatility HPMR, which should take us through the class and live trading. HPMRs have a shelf life of about sometimes 2 to 3 weeks. So you'll get the current iteration of the HPMR, but that HPMR, come say August, is probably going to be invalid. But for the class, you will have the current, and for the live trading, you will have the current HPMR. All right. So yes, you will get the current HPMR, but they're not good forever, because remember, volatility is always expanding or contracting, etc. So the longer it stays status quo, which it might through summer, the HPMRs that I give you for the class may take you through summer. It's really going to depend on how much increase or decrease in the historical volatility we get. So those get recalculated based on market behavior, really. All right. So I hope that helps. And by the way, if you want to check out the webinar, or the class, you can head on over to simplertrading.com/climb. The class is next Saturday. And we have an update here. Let's say you watch the webinar and you want a little bit more before the class. Check out this update right here over at countdowntrader.com, which is a recent webinar that I did. Runs about an hour, talking about a lot of the tools that we'll be teaching in the class. So yeah, do check that out if you want a little bit more, kind of preparing for the class next Saturday, but that is a separate webinar. And I think the webinar that I just did, for those of you that want that replay and maybe missed it, it's at, here it is. It's simplertrading.com/entry-replay. Entry, let me see if I can get it here. There we go. Entry-replay. So if you want the webinar that I did just this past Wednesday, entry-replay. And by the way, I have another webinar coming up next Wednesday, and we're going to dive a little bit more into the ETFs. We're going to have it. So a lot of folks ask, Rog, this next webinar you have coming up, is it the same as the one you did this past Wednesday? No, my webinars are never the same. So on Wednesday, we're going to dive a little bit more into ETFs, and I'll explain to you what I've been doing day trading there. So when you get the email to sign up for the next webinar, it is absolutely a different set of slides and information from the first. You'll definitely want to check them out. And again, if you're ready to go, just head on over to simplertrading.com/climb. It's going to be the day trading playbook. And for those of you that are wondering, what's the big difference? The big difference is we are going to get very tactical. In other words, this is not going to be a rehash of what are grab candles and what is propulsion. We'll go over that material for those of you that are new to that pretty quickly. And I'm probably going to create a video on those tools that you guys can watch before or after the class, so we don't have to spend a lot of time on those tools that probably many of you are already familiar with. The idea is to get tactical quickly, talk about the exact setups, timing, a lot of, again, think about a playbook. Those of you that are sports fans like me, imagine you've just, I live in Florida. So let's say you just got, you signed with the Miami Dolphins, and you're an offensive player. It has handed you the playbook for the team. That's what I'm handing you. I'm handing you the playbook. So really stoked for this class. Haven't quite done something like this before, where we get really, really specific to if this is occurring, if this is what's happening, and this is the structure of the market, this is the play we want to run. All right. So I'm really excited for this. Have a great one. Have a great weekend. Be careful. Friday doesn't always like traders. This one's going to be a little chaotic with the potential of volatility for triple witching. Next week, we can take a look at the market after all the dust is settled. Don't overdo it, but if there are some relative outperformers, a couple of which we talked about in this session, you can jump into those and try to take advantage. All right. Have a great one. Be good to each other. I'll see you next week.